Silver has crossed $80. Not quietly, not gradually, but with pressure building beneath the surface. Most investors see a price chart. Very few see the stress inside the system. Inventories are tightening, physical premiums are widening, and somewhere in the background, someone is scrambling to secure metal that may no longer be easily available. This is not about excitement. It is about imbalance. If $80 was a ceiling before, why does it feel like a launch pad now? And if a short squeeze is forming, who is trapped on the wrong side this time? Because if $85 breaks, the move toward $100 may not wait for permission, but the real question is not whether silver rises. The real question is, who is unprepared when it does? When silver moved above $80, most people saw only a number. Traders saw momentum, commentators saw volatility, but serious business leaders saw something deeper. They saw pressure building inside a system that had already been tight for years. Silver has reached high levels before. In earlier cycles, it spiked quickly and then fell sharply. Those rallies were often driven by speculation. Fast money entered, fast money exited. The structure underneath remained weak. This time, the foundation appears different. The global silver pricing system depends heavily on COMEX in the United States. Futures contracts traded there determine the benchmark price seen across financial markets. At the same time, large volumes of physical silver are cleared and transferred through the London Bullion Market Association. Together, these systems connect paper contracts with real metal stored in vaults. When silver crossed $80, signs of strain inside that structure became more visible. Inside exchange warehouses, silver is divided into categories. Registered silver is ready for delivery against futures contracts. Eligible silver is stored in the vault, but not committed to delivery. In recent months, registered inventories have shown signs of decline. Some metal has been moved into eligible status, reducing the amount immediately available for settlement. For a business leader, this detail matters. Metal that cannot be delivered is not true liquidity. It is inventory that exists, but is restricted. If more contract holders request delivery while registered supply shrinks, tension builds. At the same time, reports from physical dealers indicate strong demand. Premiums above the benchmark futures price have increased in some regions. When buyers consistently pay more than the quoted spot price, it suggests that supply in the real market is tighter than it appears on screens. Silver also carries a dual identity. It is both a precious metal and an industrial input. It is essential in solar panels, electronics, medical equipment, and defense technologies. Industrial demand tends to be steady. Manufacturers cannot easily substitute silver in high-performance applications. When supply tightens, they must compete for available material rather than delay production. For several consecutive years, global silver demand has exceeded newly mined supply. Mine output has not grown significantly. Many silver mines operate as byproducts of copper, lead, or zinc projects. This means silver supply often depends on decisions made in other metal markets. If base metal production slows, silver output may also decline. At the same time, renewable energy expansion has increased structural demand. Each solar installation uses a small amount of silver. Individually, it seems minor. Collectively, across millions of panels, the total demand becomes meaningful. This background changes how the move above $80 should be interpreted. If the rally were purely speculative, it would likely occur during periods of abundant supply. Instead, it is occurring during years of documented deficit. That difference is critical. Lease rates in London have also shown periods of elevation. In simple terms, it has become more expensive at times to borrow silver. Rising borrowing costs often reflect caution among holders. They may prefer to retain inventory rather than lend it out freely. Such behavior usually appears when participants perceive tightening conditions. Business owners understand this pattern well. When raw materials become uncertain, suppliers become protective. Credit terms tighten, prices adjust. The return of silver to the $80 level also carries psychological importance. Markets remember prior highs. In previous cycles, silver failed to sustain levels near this range. When price revisits such territory and holds steady, it signals resilience. It suggests that selling pressure is being absorbed rather than dominating. None of this guarantees a straight move to $100. Markets are rarely linear, but the structural elements supporting this price level appear stronger than in earlier speculative spikes. For the business community, the message is not to celebrate or fear volatility. It is to recognize signals. When a metal critical to modern infrastructure trades at elevated levels during a supply deficit, it reflects more than excitement. It reflects constraint. He or she analyzing the situation would ask practical questions. Is new mining capacity coming online soon? Are governments adjusting critical mineral policies? Are industrial buyers securing long-term contracts? So far, supply growth remains limited while demand remains firm. Silver at $80 may not represent a peak. It may represent the market's attempt to rebalance years of tightness. The key issue is not prediction, it is preparation. If this breakout reflects structural stress rather than temporary enthusiasm, then serious decision makers must begin evaluating how prolonged tightness in silver could affect costs, margins, and strategic positioning in the years ahead. Most shortages begin quietly. They do not start with headlines, they start with imbalance. Contracts written in confidence. Inventory assumed to exist. Obligations built on trust that metal will always be available when needed. In the silver market, that assumption may now be under strain. A short squeeze is often misunderstood. In simple terms, it happens when those who promised to deliver an asset must rush to buy it back because supply becomes tight. In equities, this can create dramatic price spikes. In commodities, it is more complex. Because in commodities, delivery is not theoretical. It involves trucks, vaults, refineries, and real metal. Silver trading is heavily concentrated in futures markets such as COMEX. Large banks, hedge funds, producers, and industrial users all operate there. Many commercial participants use short positions to hedge production. That is normal. A miner may sell futures contracts to lock in a price for metal it plans to produce later. But problems arise when short exposure grows too large relative to available physical supply. If inventory in vaults declines while short positions remain high, tension builds. It is similar to a business selling more units than it has in stock, assuming it can replenish inventory easily. That strategy works until suppliers tighten. Over recent months, registered silver inventories, the portion ready for delivery, have shown signs of contraction. At the same time, delivery requests during active contract months have remained firm. When metal moves from registered to eligible categories, it reduces deliverable float. The metal still exists, but it is no longer committed to settlement. This detail matters. In a highly leveraged market, the ratio between paper contracts and physical ounces can be large. As long as most participants settle in cash or roll contracts forward, the system functions smoothly. But if confidence changes and more participants demand delivery instead of rolling contracts, the strain becomes visible. There have also been signs of stress outside the United States. In Asia, physical premiums have occasionally traded above Western spot prices. When buyers are willing to pay more locally than the global benchmark, arbitrage should close the gap. Traders normally move metal from lower-priced regions to higher-priced ones. But when logistics slow or inventories tighten, that process weakens. The London market, managed through the London Bullion Market Association, plays a central role in global clearing. It operates largely through interbank lending of metal. Banks lend silver to one another for short periods, smoothing liquidity needs. Historically, lease rates in London have been low and stable. When lease rates rise sharply, it suggests lenders are cautious. They may fear that recalling metal later could become difficult. Rising lease rates are not dramatic headlines, but to professionals, they are warning signals. A short squeeze does not require conspiracy, it requires mathematics. If a concentrated group of traders holds large short positions and physical supply tightens unexpectedly, they face risk. If prices rise quickly, margin requirements increase. To maintain positions, they must post more capital. Some may close positions by buying back contracts. That buying adds upward pressure. If delivery months approach and available metal is limited, the situation intensifies. Participants may negotiate private settlements or roll forward contracts. But if too many demand physical delivery at once, the exchange must manage the imbalance carefully to maintain stability. This is why commodity squeezes can be more consequential than equity squeezes. Commodities are embedded in industrial systems. When volatility increases, manufacturers feel it. Financing costs rise. Hedging strategies are tested. The current environment shows several ingredients of a potential squeeze: declining deliverable inventories, persistent industrial demand, rising physical premiums, and visible lease market tension. However, responsible analysis avoids exaggeration. A squeeze is not guaranteed. Exchanges have tools, margin adjustments, position limits, and cash settlement options to stabilize markets. Large participants may also reduce exposure voluntarily if risk grows. But what concerns serious observers is the structural backdrop. Silver supply has not expanded meaningfully in recent years. Exploration budgets were cut during prior downturns. New mines take years to develop. Recycling supply depends on price incentives. Meanwhile, global industrial demand has grown steadily. If short exposure was built during periods of lower prices, and physical tightening continues while price remains elevated, pressure does not disappear. It accumulates. For business leaders, the issue is not speculation about dramatic price spikes. The issue is liquidity risk. When markets become thin, volatility increases. When volatility increases, planning becomes harder. A hidden short squeeze is not loud at first. It appears as widening spreads, rising borrowing costs, and unusual delivery activity. Only later, if stress intensifies, does it become visible to the public. Those who operate businesses dependent on silver inputs must ask a practical question. What happens to procurement costs if volatility accelerates? What happens to working capital if suppliers demand faster payment or higher premiums? The anatomy of a squeeze is built on simple principles: leverage, limited supply, and shifting confidence. Silver's move above $80 may not be the result of a squeeze alone, but if structural tightness persists, the probability of forced repositioning in derivatives markets increases. And in commodities, forced repositioning rarely ends quietly. Long before prices rise sharply, governments begin to pay attention. They do not announce concern immediately. They do not signal urgency in public speeches. Instead, they adjust classifications, review supply chains, and quietly reassess which materials are essential to national strength. Silver has increasingly entered that category. It is easy to think of silver only as a precious metal, an investment asset held in coins and bars. But in reality, silver sits inside solar panels, missile guidance systems, medical equipment, 5G infrastructure, and advanced electronics. It conducts electricity better than any other metal. It resists corrosion. It performs under stress. In a world moving toward electrification and digital infrastructure, those qualities are strategic. Over the last decade, governments have expanded their lists of critical minerals, materials considered essential for economic and national security. Once a metal appears on such a list, policy begins to shift. Financing becomes available. Domestic processing receives incentives. Strategic reserves become a possibility. When a commodity moves from market good to strategic input, the rules change. The silver market remains global, but supply chains are not evenly distributed. Much of the world's refining and industrial demand is concentrated in Asia. Financial clearing remains centered in Western hubs such as London and New York. Mining operations stretch across Latin America, Australia, and parts of North America. This geographic separation creates vulnerability. If one region tightens export controls, if shipping lanes become unstable, or if trade relations deteriorate, supply flows can shift rapidly. What once moved freely can become politically sensitive. Recent years have shown how quickly commodity flows can be redirected. Energy markets have experienced sanctions and counter-sanctions. Rare earth metals have been used as negotiation tools. Agricultural exports have been restricted during conflict. Silver has not yet faced overt export bans at scale, but it exists within the same global system. In London, through the London Bullion Market Association, much of the world's wholesale silver is cleared and traded between major financial institutions. This system relies on confidence and continuous liquidity. Metal moves between vaults, is linked between banks, and supports derivative contracts globally. If liquidity tightens in one region, pressure can transmit quickly to others. At the same time, industrial demand from Asia continues to expand, particularly in renewable energy and electronics manufacturing. If domestic inventories in those regions fall, buyers may compete more aggressively for imported supply. That competition can raise premiums locally and create strain in global arbitrage channels. For entrepreneurs and business leaders, this is not an abstract geopolitical debate. It is a supply chain risk assessment. When two major economic blocs both consider a material essential, strategic stockpiling becomes rational. Governments may encourage domestic producers to secure long-term contracts. Financial institutions may hold greater inventories as precaution. Industrial firms may sign multi-year agreements at fixed or indexed prices to reduce uncertainty. Such behavior reduces free-floating supply in the open market. The world may be entering what some analysts describe as a more mercantile era. In earlier decades, globalization prioritized efficiency. Materials were sourced wherever production was cheapest. Just-in-time logistics minimized inventory costs. Today, resilience is becoming as important as efficiency. If resilience becomes the priority, companies and governments hold more inventory. They accept higher carrying costs to ensure continuity. For silver, this shift would tighten the market structurally. This is not about dramatic confrontation. It is about strategic positioning. If one major economy believes silver is critical to its renewable energy transition, and another views it as vital to defense manufacturing, both may quietly accumulate. Neither would announce such actions publicly, but inventory data and trade flows would reflect the change. Business leaders must therefore analyze silver not only as a commodity price chart, but as a strategic indicator. When a metal essential to high technology production experiences sustained tightness, it signals deeper competition for resources. That competition can drive volatility even without visible conflict. He or she leading a manufacturing firm must consider procurement diversification. Relying on a single refining region or a single logistics corridor may no longer be prudent. Hedging strategies may need adjustment. Long-term supply contracts may provide stability even if spot prices fluctuate. The move above $80, viewed through this lens, is not merely speculative enthusiasm. It may reflect underlying strategic demand. And if silver becomes firmly embedded within national policy frameworks, whether through critical mineral designation, domestic refining investment, or informal stockpiling, The price may begin to reflect more than immediate supply and demand. It may begin to price geopolitical risk. In such an environment, volatility is not an anomaly. It is a feature of a world where materials equal power. The question for serious decision makers is not whether silver reaches $100 next month. The question is whether global competition for essential resources has quietly entered a new phase, and whether their organizations are prepared for the consequences of that shift. The discussion now turns to the number everyone is watching: $100. For some, it sounds ambitious. For others, inevitable. But serious decision makers do not deal in excitement. They deal in probability. The path from $80 to $100 is not simply a matter of momentum. It depends on structure, liquidity, and behavior inside the market. Technically, silver has already crossed a significant threshold. The $80 level previously acted as resistance. When price returns to a former resistance zone and holds above it, that level often becomes support. But confirmation matters. A single breakout does not establish a new regime. Sustained closes above $80 over several sessions would strengthen the case that this is a structural shift rather than a temporary spike. Above $80, the next technical barrier lies between $85 and $86. Historically, rapid rallies create thin trading zones, areas where price moved too quickly to build strong support or resistance layers. If silver clears $85 with volume and stability, the market may encounter limited resistance until approaching the psychological level of $100. However, price targets are outcomes. Professionals focus on triggers. There are 4 primary signals that business leaders should monitor. First, inventory behavior. If deliverable stocks on exchanges such as COMEX continue to decline, and if metal continues shifting from registered to non-deliverable categories, supply tightness remains active. Stable or rising inventories, on the other hand, would ease pressure. Second, physical premiums. If dealers consistently charge significant premiums above the futures benchmark and product availability remains constrained, it signals that the physical market disagrees with the paper price. When such divergence widens, eventual repricing often follows. Third, lease rates and interbank conditions. In London, through the London Bullion Market Association, rising lease rates indicate caution among lenders. If borrowing costs for silver remain elevated, it suggests limited willingness to release inventory into the market. Fourth, miner realized prices. If mining companies consistently report sales at prices meaningfully above the exchange average, it reflects direct purchasing pressure from industrial buyers willing to secure supply at premium levels. If these 4 signals align, declining inventories, rising premiums, elevated lease rates, and strong realized prices, the probability of further upside increases. But no scenario is without risk. There's a credible bear case. An economic slowdown could reduce industrial demand. Solar installation growth could decelerate. Electronics production could contract. If global manufacturing weakens, silver consumption would soften. In that environment, supply tightness might ease without dramatic price escalation. Exchanges also possess stabilization tools. Margin requirements can be increased, raising the cost of leveraged positions. Position limits can be adjusted. These actions often cool speculative activity and slow rapid advances. Additionally, high prices eventually incentivize supply response. Marginal mines may reopen, recycling activity may increase. Over time, elevated prices tend to attract capital. Therefore, the path to $100 is not guaranteed. It is conditional. For entrepreneurs and business leaders, the relevant question is not whether to predict the exact number. It is how to prepare for volatility. Companies dependent on silver inputs should evaluate hedging strategies. Locking in a portion of future supply at known prices can reduce uncertainty. Maintaining flexible pricing structures with customers may protect margins if input costs rise rapidly. Investors must assess exposure sizing carefully. Concentrated bets in volatile commodities can amplify risk. Diversification remains essential. Working capital management also becomes critical. In a tightening commodity environment, suppliers may demand shorter payment terms. Inventory financing costs may increase. Firms must ensure liquidity buffers are sufficient. If silver approaches $100, it will likely do so amid heightened tension, either in supply chains, financial markets, or geopolitical dynamics. Such environments reward preparation and discipline. From a probabilistic standpoint, the case for higher prices strengthens if structural deficits persist and physical tightness remains evident. It weakens if global demand contracts sharply or if inventories stabilize. What makes the current situation notable is the speed of recovery after previous declines. Markets that rebound quickly from sharp corrections often signal underlying strength, yet strength must be confirmed by data, not emotion. He or she observing this market understands that commodities rarely move in straight lines. They surge, retrace, consolidate, and then either continue or reverse. The current phase appears to be a consolidation above a former ceiling. If that consolidation resolves upward, $100 becomes not a dramatic prediction, but a logical extension of structural imbalance. If it resolves downward, it will likely do so because economic conditions changed, not because volatility alone reversed the trend. In either case, the message for decision makers is clear. Silver is no longer a quiet background metal. It has become a signal of supply discipline, of strategic competition, and of tightening liquidity. Whether it reaches $100 soon or later, the deeper issue remains. Markets are adjusting to a world where essential materials carry greater strategic weight. Those who prepare for that reality will navigate volatility with stability. Those who ignore it may find themselves reacting instead of planning.